The one thing that I have learned from spending the last 2+ years helping federal employees with their retirement and life insurance is that most of them have no idea how FEGLI actually works. So this video is going to be addressing that and how FEGLI may not be as great as what it seems. It is nice to have the option, but there are some things that you need to consider and some things that you need to know, especially if you want to have this life insurance that the federal government offers for longevity and for you to actually leave a legacy to your loved ones. Now, number one, the most common misconception I get is that people the prices increase over time with FEGLI. So this video is going to break down what those increases look like, just using an average example that we have here in our system, and we're going to dive into the FEGLI calculator to look at what those may be. So for this example, and what you guys are actually looking at here is what we call our financial forecaster. It's a really awesome tool that does a lot of amazing things for retirement income strategizing and getting people to the retirement income numbers. But also with it, we have built in a FEGLI calculator. We took all the rules of FEGLI and the three different options that it has for the option A, option B, option C, and of course we factored in the basic coverage. But to help our clients know and understand what their options for FEGLI actually are, how they work, and what it will look like for future planning of life insurance needs. So for this example, you can see here, we have a unnamed individual. We're just using a 52-year-old that wants to or plans to retire at 65. So he has about 13 years to retire. And these other numbers are just kind of factored in and are basic. Now, depending on what agency you're in, whether you're in the United States Postal Service or if you're in all the others, can dictate a little bit of changes and a little bit of nuance in this. But we're just going to keep it simple and assume that you're not a United States Postal employee. Now, if you are, you can see that there is a little bit of savings, but nothing necessarily too crazy. So if you are watching this and you're part of the post office, bear with me. I'll go back and cover you guys and your coverage at the very end here. But simply enough, basic coverage is the coverage that's offered to everybody and to anybody. And you are automatically enrolled in basic life insurance coverage unless you choose to actually waive it. Now, basic coverage is pretty simple. It takes your annual basic pay, rounds it up to the nearest thousand, and then adds $2,000 additional onto it. So as you're getting pay increases, your basic life insurance is keeping up with it and going up as well. And it will always be based on that rule of round up to the nearest thousand. So in this scenario, for 24, round up to $80,000, and then we're going to add an additional $2,000 on. So this person's basic coverage would be $82,000. Now, based on this, and based on this calculator here, you can see that it starts to factor out and calculate what the monthly or biweekly premium would be for this life insurance policy. And now the unique thing for the basic coverage is that the government pays for 1/3 of the premium or of the cost for the basic coverage. The employee pays 2/3. Now, like we mentioned with USPS employees, the government takes care of the entire premium for you. So that'll be really the only difference in this. But for example, whether you are post office or any other agency, you can see that your basic coverage is a lot less than whenever you go to retire. And actually also, if you were to go to retire before the age of 65, you can see that based on whenever you retire, the price significantly jumps up. And keep in mind, these are still biweekly costs, right? So while you're working for this $82,000 of coverage with the basic coverage, there's a formula that factors in the premium. It's not typically a lot. In this scenario, you can see it's just $28 a month. But whenever you retire, it goes up significantly. And for this individual, it would actually go up to $461 a month for a few years. And then at age 65, the price does decrease a little bit, but then it's still $400 a month for that $84,000 of coverage. They add in a little bit extra there, about $2,500 extra, just to help with the burial or funeral costs. So they do give you a little bonus, but in this scenario, that would cost you about $400 a month to maintain and to keep that. Now, once you get to retirement, and it with the basic coverage, but you can reduce the basic coverage that you have. And what I mean by that is you have the option to reduce it by 0%, by 50, or by 75%. And if you go with the post-retirement basic reduction to 75%, it will reduce your cost. I'm sorry, it'll reduce your coverage and your cost by 75%. And you can see here that actually, and so actually this would have it that at age 65 and beyond, your basic coverage would have no cost to you. And this is what a lot of federal employees do and what they opt for with their life insurance because they don't want to pay this $461 a month, right? So they go with an option that reduces the coverage. And then you can see here that over time, you reduced it by 75%. So it takes a few years. And then eventually, in this scenario, it would get down to the point where you would have about $23,000 of coverage for the rest of your life at no cost to you. So that's the basic coverage. Okay. Option A is what they call a standard coverage. It just provides an additional $10,000 if you want a little bit extra. And the unique thing about option A that we really like is that when you turn 65, actually, the cost goes away. So you don't have to pay for the premiums anymore of that $10,000 of coverage, but you do have some premiums while you're working. And you can see here for this person, this individual at age, 52, it's only about $1 biweekly. And then at age 60, it goes up to about $6 biweekly. And then at age 65 and beyond, there is no cost to it. So that's option A. Very, very simple. Now, option B, we find that a lot of employees have this option B, which is the multiple of your income. You can have 0, 1, 2, 3, 4, or 5 multiples of your income. So let's just go to the 5 multiples. So what it does is it rounds your coverage, it rounds your amount to like the nearest thousand and gives you 5 multiples of that. So in this scenario, this person would have about $400,000 of coverage if they took 5 multiples of their approximate salary of $80,000 a year. Now, here's the thing with option B, life insurance from FEGLI. While you're young, the insurance is really, really cheap. Also, with FEGLI, one thing to keep in mind is that FEGLI insurance, there's no underwriting. You don't have to go through health questions. So for individuals that may have underlying health conditions, FEGLI is a great option, right? And that's the case with most employers and most group life policies. As long as you're part of the group, typically you're okay to get the life insurance coverage, and especially in this scenario. But if you're very healthy, it may make more financial sense, or in the long run, could save you some money if you had your own policy outside of the federal government. And here's what I mean about that. You can see here, while you're 52 in this scenario, the coverage is fairly cheap for $400,000 of coverage. This is bi-weekly, so probably a little bit over like $80 a month, right? And so that is until though you turn 55. And then you can see here at 55, the pricing goes up. And then at age 60, the pricing goes up again. And at age 65, the pricing goes up again. Age 70, now we're talking nearly $344. And keep in mind, this is not monthly. This is still bi-weekly. So multiply that by 2 and a little bit more than 2, technically, because there's, I guess, what, four and a quarter weeks technically per month if you did the math. But this would be almost $700. Actually, yeah, it shows us this here because there's no other premiums, right? It would be $745 a month for you to keep your $400,000 of coverage at age 70. Once you get to 75, we're talking $1,500 a month. And of course, here at age 80, nearly $2,400 a month. And unfortunately, the option B coverage gets to be the cost or the amount of what your pension is coming in. And that was never the intention or the purpose of life insurance, right? You shouldn't get life insurance so that your whole pension check just goes for paying for your life insurance. This is why I was talking about your own option outside of the federal government could make a lot of sense, especially if you want something for the long term and something that's going to be a guaranteed legacy to leave your loved ones. Unfortunately, I was talking with an individual the other day who's 59, and you can see here at 59, they haven't quite seen all these high price jumps. So they were not aware of what was to come, but they have had, I think it was 500,000 or so of coverage, about five multiples of their income for the last several years, and they were not aware of these huge price increase jumps. Now, unfortunately for them, this is their only option. A couple of years ago, they had a health condition come up, and now I don't believe that they would be able to get approved for these larger life insurance policies outside of FEGLI, right? So follow along with me here. As long as you're healthy and in relatively good health, you can get approved for, one of these larger policies if you want it. If you wanted something outside of the government that you had control over. Some of the options can be coverage that lasts for your whole life, or sometimes a term coverage. Maybe you can get a term policy for 10, 20, or 30 years. Term policies are really good if you just want to protect yourself, maybe up until retirement. So for this individual that's 52, wanting to retire at 67, that gives us about 15 years until retirement. A 15-year term policy to get them to retirement, if that made sense for them, would make a lot of sense. And keep in mind, that would prevent them from having to pay, the nearly $375 to $444 a month of life insurance costs that they would have. We can lock in a little rate that's maybe somewhere in between here. I don't know what the numbers would look like off the top of my head, but I'm just talking conceptually, right? So that's option B. I think I covered everything with option B that I wanted to, and I think that is a good point then to transition to option C. Option C is like the family coverage, and I guess more so it's for spouse. And then if you have any children, you can add your children on as well. Each multiple that is reflected here for your spouse, each multiple is a $5,000 increment. So if you select three multiples, you would have, you can see here, $15,000 of coverage for your spouse. If you had two children, let's do four children. It doesn't matter how many children we put in here, but for each child, for one child, each multiple is equivalent to $2,500 of coverage. So you can see here, if you had one child at three multiples, that would be $7,500 of coverage, and that's what's being reflected and shown here. Same thing with option C. The cost goes up, it increases over time. Now, this isn't much coverage to begin with, but keep in mind, the cost goes up, and with any life insurance policies where the cost goes up over time, especially if you want the coverage for the long term and for the rest of your life, you're probably better off just having your own life insurance policy that you own and control, and that's not through your employer. And this goes whether you're working for the federal government or you're not. But if you're watching this video, you're probably working for the federal government, right? Otherwise, you wouldn't be watching a video on FEGLI. But these are the three different options. So you have your basic. You have to take your basic coverage if you want to look at either option A, B, or C. And now for these different options A, B, and C, you have to wait for an open season to make any changes to increase your coverage. Or if you have any qualifying events that give you an opportunity or a window. And some of those opportunities to make those changes are significant life events, a marriage, divorce, birth of a child, and so on. So with that, if you've made it to the end of this video and maybe this video has actually just given you more questions than answers about your FEGLI coverage, and maybe you're uncertain about, the longevity and what the raising costs are going to be on your FEGLI coverage. If that's you and you made it to the end of this video, I want to offer you a free one-on-one consultation that we can meet one-on-one, and we'll talk about and actually plug in the numbers and see where your FEGLI life insurance is going to end up 5, 10, or maybe 20 years from now. And if you have a concern about it, we can weigh the options and look at something that you actually own and control versus just having all of your life insurance be through the FEGLI system. FEGLI is not inherently bad. There just may be some other options that could be better out there for you. So if you made it to the end of this video, there will be a link below to our website, thewealthacademy.com. My name is Kyle Demian from the Wealth Academy. And on that link, on that website, you'll see a link there that just says to schedule a call or to chat to learn more. And go ahead and go there, click on the link, schedule a time to chat, and we'll spend at least 10 to 15 minutes just to figure out, where you're at now, what life insurance options you have, and then we would schedule, a follow-up meeting. That way I can do some diagnosis and look at the different options that would be out there, and we can talk about those and go from there. Hope this video helped. If you got any good information out of it, I would greatly appreciate if you could just go ahead and like the video below and subscribe to my page if you want to keep up to date on retirement information, life insurance information, and especially if you're a federal employee, we've been trained as federal retirement consultants. So we've done the education and the training in the past to become more equipped to help federal employees like yourself. So thank you guys for tuning in, and we'll see you guys on the next video.